MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back.
Ross, 2 years ago, on February 6th, so pretty well this date, you came on the show and stated your data was already showing a 27% house price decline for Vancouver. Today, 2 years later, we're seeing homes sell at those discounts. How did you know 2 years ago what we're seeing now?
Well, I mean, that's the great thing about House Street, and that's the great thing about having everything you say recorded for posterity here on your channel. As we said on your show many a time over the last couple of years, housing markets move years in advance of the public being aware the markets have moved. What I'm saying to your listeners with that comment is that a housing market is made up of a whole bunch of different components. There's the brand new home market. There is the existing home market. There is the mortgage market. There is the household market, which people don't understand, but that is the one where we look at the tenancy situation as well. All of those different parts of the market interact with one another, and how they're interacting at any moment in time is going to have a consequence. So when we're talking last year at this time, when we said that, I think it was actually the fall of 2016, so it was even before the show that we had gone public and said we had recorded about a 26.4% house price decline that you're going to see out there. We were reading what was happening in the other components of the market, which eventually show up at the very last date in the resale market, the existing homes market. What your listeners need to understand is that when you hear organized real estate talking about their stats, talking about their sales, talking about their benchmark prices, talking about their listing count, that is the very last data point that is ever released in a housing market. It is the very last data point. All of the data, all of the market activity that leads up to those organized real estate stats happened a long, long time ago, as much as 2 years ago. How do I explain that to your listeners? Let's look at recently Altus Group has gone public about falling new home sales in 2018. What Altus is saying about falling home sales in 2018, you're not actually going to see recorded in resale existing organized real estate sales stats for 2 more years. Because what they're actually commenting on are pre-sales, sales that take place in a builder's trailer. Those sales can take anywhere from a year to 5 years before those houses are built. As those houses are closed upon or pending their closing dates, other activities have to take place in the market. And when those other activities have to take place, they happen in the existing homes market. That means a year, 5 years later, the existing homes market is going to be impacted by that sale that took place in 2018. When we're talking about a housing market, we're looking at all of these levers. We're looking how all the data points are interacting. So back in 2016, we were actually reading data from way back in 2014 when we made that call. And here we are another 2 years later, 2 years after that show, which I think is still archived on your homepage. And you're seeing those numbers now show up in sales all over the place. We're seeing the 40% declines that we talked about last year that were going to take place. You're seeing that happen. You're seeing the condominium market, sales evaporate. You're seeing the price of condominiums fall. Again, back on House Street, a year ago, we explained to everyone how soon as you remove the $37,000, selling prices were going to drop. That's exactly what happened. When you're seeing someone commenting about a housing market, talking about sales in January for the sake of the argument, or selling prices, benchmark prices in January, you're actually looking at information that is a consequence of activity that took place 2 years ago. It is outdated. It is latent. It's why the myth that you can't time a housing market exists. The most important metric that we measure, Jim, is mortgage debt. Mortgage debt to us is one of the key components that we measure, and we don't really talk about it too often. We measure it totally different than everyone else does, including Bank of Canada, CMHC, economists, and realtors. We look at it totally differently because we're looking at it as a closing date phenomenon. Again, the very, very last trailing measure of a housing market. Even your organized real estate sales lead closings by 2 to 3 months. So when you see the Bank of Canada posting mortgage debt growth, which again is an irrelevant calculation as far as reading what's going on in a housing market, that is a consequence of decisions from years ago finally showing up as homes close and the mortgages are booked to close them. The 27% call we made here on the show 2 years ago, that was not a genius call. That was not an idiot savant's understanding of a housing market. That is simply how housing markets function. With the data points that we're reading today, the public is not even going to see those for another 2 years. And if there's any little tiny change that takes place over those 2 years, we can adjust our forecasts to be that much ahead of the market. It doesn't matter to us. The only I guess the only reality about our business is the fact that the Wealthy Homeowners platform and Ross K. Realty Consultants, the business that we do, is that it takes so long for an opportunity to arise where you get to be proven right or wrong. You are proven right or wrong in the business that I'm in by giving people leading notice of when the market is going to change. Your listeners here on House Street 2 years ago in Vancouver got an example of that warning. 2 years notice, which you're seeing today. In Calgary, back in 2013, they were given notice. The Wealthy Homeowner didn't even exist in 2013. It was only a premise, an understanding of what we were going to do. We hadn't even got permission from David Chilton to use the term the Wealthy Homeowner, because I would never have stepped on Mr. Chilton's toes if I hadn't spoken to him and asked him if it was okay that I used that term in our name. He didn't endorse us. I'm not saying that, but he told us to go ahead and use that name. He said that he had no problem with it. What you're seeing now today, when you're recording these 26, 27, 40% house price corrections of some properties in Vancouver, is all the result of decisions made in the market years ago. Anyone who's commenting on the market, looking at the real estate stats from the Real Estate Board of Greater Vancouver today in Vancouver, or the Toronto Real Estate Board tomorrow in Toronto, is reading information that's 2 years too old. The market has already moved on. What they're trying to pretend is the market today is actually 2 years old, or maybe longer. And I think that's what your listeners can take from the accuracy of that forecast from 2 years ago.
We'll have more with Ross Kay right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the Pink, symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, on January 18th, you warned us on the show that the GDP was set to decline. Last week, we heard that in the 2 of the last 3 months, the GDP across the nation declined. What do you foresee in the coming months for our economy?
Yeah, I think you're quoting the January of 2018.
Right.
Not January of 18 of this year, but a year ago, over a year ago. On the show, we had warned about GDP's decline. So our understanding of the housing market and its impact on the greater economy in a country like Canada, the housing market reigns supreme. And I think if your listeners think about it for a moment, and they look at where the vast majority of their monthly income goes, they'll realize that it is spent on housing. It is spent to put a roof over their home. It is then spent on groceries, property taxes, heat and hydro. The vast majority of their income goes there. If they've been in a house for 7 to 8 years, then probably the highest percentage of their income goes to income tax, then their house, and then whatever they have left goes towards a car or everything else. The wealth effect that is created from the home trading cycle is all power. It rules everything. It rules the amount of mortgage debt that is going to be booked. It rules whether or not CMHC goes up against its limits and has to call upon the government to increase them. And then, shockingly, CMHC does not realize in 2013 that the trading cycle has moved and they are no longer going to need mortgage insurance for first-time home buyers to the same degree they were in 2012. Household spending. People moving into their houses, renovating their houses, improving their houses. GST, HST on any transaction associated with anything to do with their house. All of these things are impacted by the home trading cycle, which we call the realty cycle. The realty cycle leads the business cycle by up to 2 years. The realty cycle has never, ever signaled a warning of a recession that was not proven true after the warning was signaled. GDP in Canada is probably running around 78% based upon household consumption. So 78% of the economy is based on household consumption. Canada's debt surplus, or surplus to debt with other countries, trade surplus, is basically neutral. We are not bringing in enough new money into this country to offset the money that we're sending out. It's basically breaking even. With some countries, we have a positive, we have a surplus. With other countries, we have a deficit. It comes out basically even. There is not enough money coming into this country via trade to make our GDP continue to grow. It is household consumption that dictates that. Obviously, it only makes common sense that if we are not bringing more money into this country than we're shipping out, any growth has to come from within. Now, I'll let economists talk about the amount of money in the economy, how governments grow the money supply. Those things are really not something that I've spent a lot of time studying. Although, if you want to put a couple weeks in, I'm sure that you can become an expert in that field as well, because it's all available in textbooks. It's all available to study. What's not available to study is the home ownership market. It does not exist. An economist cannot go to a post-secondary school in this country and learn about a housing market. It's why the supply and demand myth has been so miscommunicated the last couple of months. People want to ask Ross, what is the answer? What is the answer to affordability? It's a two-pronged approach, folks. One is a housing correction. And a housing correction within the Canadian home trading infrastructure is unavoidable. The infrastructure itself, because it is designed for realtors to earn commissions and banks to lend mortgage loans, it naturally causes housing bubbles, and they're going to break, and you naturally have to have a correction. That is unavoidable under the current structure under the current infrastructure that homes are traded in. Gross domestic product, household consumption, is dictated by that trading cycle. Anyone who believes that home prices increased 35%, 35% in Vancouver in the spring of 2016, or 30% in Toronto in the spring of 2017, is simply believing a myth. The trading cycle is a constantly shifting share of sales going to each category of home buyer. As that shift takes place, house price illusion appears. It gets greater until it can no longer be sustained. When it's no longer sustainable, you get a correction, which is what we're in right now. I don't care what the Real Estate Board of Greater Vancouver is telling people in Vancouver today. I don't care what the Toronto Real Estate Board is telling people in Toronto tomorrow. I know who their board staffs are. They are laughed at real estate offices across the nation because they don't know what they're talking about. They were never hired for the purpose they're pretending to be experts on today. They were never hired for those jobs. When I hear the Real Estate Board of Greater Vancouver today claim more people were at our open houses have picked up, but home buyers aren't buying. I think they posted about 1,100 sales in January with their members. 1,100 sales is what they posted. And I'm sure that they compared it against last year's sales, and they probably had a 30 to 40% decline. That's not how we look at the market. We look at the market is the Vancouver home buyers were purchasing 130% more homes at the peak of the market than they are today. A 130% increase was taking place with the number of people that were buying homes back in 2016. You're not going to read that in a paper today. You're not going to hear that come out of the mouth of a organized real estate. You're not going to hear an economist, an analyst, except those who listen to this show and then magically their blog postings start to post what is said on this show a weeks or months later. You're not going to go back and look in the history. You're not going to find it. We pulled an old news ad from CBC this morning, and it was back in 2012 when Jim Flaherty, then Minister of Finance, lowered the amortization level to 25 years. He dropped the maximum amortization level to 25 years. Dropped the maximum home purchase insurable by CMHC to $1 million. You didn't hear anybody in 2012 saying what Mr. Flaherty is doing is naturally going to cause house price inflation over the next few years. You didn't hear anybody saying that because they don't understand how a housing market works. What Mr. Flaherty did was, what he said was, by this change, I'm only going to let those with higher credit scores and higher levels of income purchase homes in this cycle. And as time goes on, the person who's able to qualify is increasingly going to become wealthier and wealthier and wealthier. Those with less wealth will not be able to qualify. It's a self-fulfilling prophecy. You didn't hear any economist with any bank anywhere say what Mr. Flaherty was doing was going to cause house prices to rise beginning in the second half of 2013, which is exactly what happened. It was just the opposite. Organized real estate was forecasting Armageddon. They were forecasting huge sales declines. They were forecasting it's going to hurt prices. It's going to hurt the market. Well, it really did hurt the market, just not the way that they thought it was going to hurt it. It was just the opposite. Exponential price growth took place. It had nothing to do with the value of the homes. It was just which homes were being purchased. And every single month, the public was fooled. They were fooled 47 months in a row because no one explained the truth to them. Your gross domestic product is exactly the same. Why, for 2 of the last 3 months, did GDP fall? It fell because back in 2015, the amount of mortgage debt being booked in the home trading infrastructure began to decline. That's right, listeners. All of those things you've heard about, published by everyone, about record mortgage debt in 2016, record mortgage debt in 2017, record mortgage debt in 2018, and now 19, because we just had another 3% rise in mortgage debt year over year. We would say during that entire period of time, mortgage debt was falling. Falling mortgage debt during that period means rising house prices because it's richer people who were buying homes. So when we forecast about GDP here on the show back in January of 2018 that it was going to fall, it's because that we were now already almost it was 2.5 years. It was 2.5 years into our reading of the mortgage market from 2015, which historically is exactly when you're going to see the change take place in gross domestic product. What happened? Bang, right on schedule in October. You saw that decline. November, we got a little fudge because of the contraction bump that happened in the national housing market. Back in then December, it dropped again. These are not surprises. These should fool no one. The Bank of Canada should know this information. They don't. If we were right a year ago on this show, and we gave them almost a full year's notice of the GDP declines. How come when you go back in January of 2018, no one else made those forecasts? It's because we're measuring the housing market. We're measuring it years in advance. The housing market, the infrastructure always works in the exact same way. There is no way of avoiding it.
So, Ross, what is the answer? What's going to happen with our economy?
Well, what you're going to see is you are going to see panic set in, Jim. I really believe you're going to see a level of panic we have never experienced before in this country, because we have never gone into an election 3 years into a housing correction. That has never happened. So let me be clear to your listeners. By the time you're going to the polls this fall, Canada will have been 3 years into a correcting housing market. You're only starting to hear about it now. You're going to be 3 full years into it. Now, we can go back to the 2007-09 period, and we can look at the data and compare that to what's happening now. We can go back to the early 1990s data, late 80s, early 90s, compare it to what's happening now. We can go back to the early 1980s data and compare it to what's happening now. They're identical, folks. They are so identical, it's scary. You would actually think we fudged the numbers. When you're looking at it, Jim, it almost seems too perfect. We all know what happened in those 3 periods. What I'm not telling your listeners is what happened in the mid-90s, when the fallout of the early housing market of the late 80s, early 90s, had the second wave of fallout in the mid-90s, because that housing market did not fully correct until all the way out till 2003. It was a 13-year housing correction. Now imagine how long this housing correction is going to take place. The flip side of that, though, Jim, is this. When people quit spending money on their houses, within a certain margin here, I mean, there's certain money you have to spend on a house every year. But when people aren't going out and continue to buying bigger and better houses, they start spending money on other things. So as you get into a correction, into the 5th, 6th, 7th year, you're going to start to see other aspects of the economy improve. You're going to see business investment improve, because instead of investing money into their house, they'll invest money into the stock market. I mean, I poor pity the stockbrokers from 2013 till 2018. They've watched all of this going on in the housing market, but they weren't seeing that kind of capital flow into the Canadian business market. Well, for those people, they need to understand capital flows either into the housing market or the business market. It doesn't flow into both. Again, the home trading cycle is all powerful. On the downswing, money is able to go into the business market. As the home trading cycle is on its upswing, money's pulled out of the business market and thrown into the home ownership market. I think as we look at, probably 2025, 2013, 2030, there will probably be enough academic study done about housing markets and how they interact in a huge housing correction that next time around, your economies are going to have a little bit of better understanding of what they're going to go through right now.
We'll have more with Ross Kay right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, mortgage debt again posted a gain in December, and once again, rating agencies are after our politicians to rein it in. Should they be doing that, or are these agencies wrong?
Well, Jim, you want a recession? I'm not even joking. Like, I literally am not joking. Do we want a recession in this country? And that's a choice that people have to make. Politicians are not prepared to make that decision. They are not prepared to deal with the fallout of a recession. Is it unavoidable? Is the current trend in gross domestic product changeable? Can they change it? Well, I know we can't change exports because now we are competing against an American powerhouse under a set of terms where Canada is at a disadvantage. The new NAFTA, it puts us at a disadvantage. So everybody can comment about Trump all they want. What he did was he protected American workers. And I don't care what anybody said. He protected American homeowners. We Canadian homeowners receive no such protections. As a matter of fact, their livelihood has been placed at risk because of NAFTA. So then we have to go back to this mortgage debt discussion with credit agencies. If you ask a credit agency, what is a mortgage coverage ratio? They're not going to be able to answer it. If your clients Google mortgage coverage ratio, you're not going to find anything there. Yet, your mortgage coverage ratio dictates your income to debt level. It isn't magic. It's just the way that the numbers work. These credit agencies, I genuinely believe, and this is not conspiratorial at all, Jim, I believe they use fear to drive the profit margins of those whose interests they truly serve. I believe they set a straw man out there that places the regular Canadian consumer at risk. When I see Christine Lagarde from IMF speaking about Canada's debt, I say to myself, so, lady, what planet do you live in? In this country, the only country in the world where this is possible. A young couple working minimum wage at McDonald's can be millionaires by the time they're 60 years old. A new migrant family coming to this country from an impoverished part of the world with nothing but the clothes on their back can begin working at Walmart as quickly as they can get a SIN number. And within 30 years from their first employment date at Walmart, they can be millionaires. There is no country in the world where this is possible. When we hear credit agencies talking about comparing Canada to the United States, Canada to Australia, Canada to the UK, then we say to them, okay, interesting. Can a minimum wage income family, husband and wife both working, 2 kids, own a home and become millionaires in 40 years? 30 years? No. Only in Canada. Can one of those parents always be home with the kids without having to put them in daycare if they so choose, other than in Canada, and with both parents working minimum wage jobs, becoming millionaires in 30 years? I don't think so. Is there another country in the world where two parents can work minimum wage jobs, build a financial life that will make them millionaires in 30 years, own their home free and clear after the 30 years is up, and their children can go and receive a degree program at a post-secondary world-class university in Canada for free? Can any place else in the world make that claim? All of that? What are these rating agencies talking about? The reason why Canadians can take on more debt and not be foreclosed on or be exposed to the same level of risk that happens in other countries in this world is because we have a healthcare system. We have a healthcare system where you can work minimum wage job and you have to spend nothing on healthcare. You can get married, have 2 kids, your husband can stay at home, be at home when the kids come home from school, or in the early years, you can stagger your shifts at Walmart, and you get to build a life because of the infrastructure that supports life in this country. So when we hear these credit agencies criticizing Canadian mortgage debt or Canadian consumer debt, I'm asking, well, why don't you mention the fact that a standard family of 4 in Canada doesn't have to spend $1,500 a month on health insurance? How come you don't mention that? This is the same argument, Jim, we use when we hear Unifor talking about wages in the auto sector. We ask the question, what are you talking about? Why don't you open a plant in Windsor, Ontario? And why don't you just offer to pay your auto workers $18 an hour, $4 more an hour versus minimum wage? Because those auto workers setting up their life down in that part of Ontario will have a better and wealthier life than stockbrokers, real estate agents working in New York City in the United States of America. Why are we not harnessing the power of our nation, which is our federally funded, taxpayer funded healthcare system? When you read the comments from these rating agencies about Canadian debt, ask for the little footnote that makes a notice of an adjustment made for Canadians not having to pay health insurance every month. And then consider what it would be like to be an American working in Georgia, making $20,000 a year at the Alabama Mercedes-Benz plant, but you can't afford the health care for your family because it's $2,000 a month. So, my answer to these credit rating agencies is simple. Where is the straw man? Why are you setting us up in the way that you're setting us up? Why are you comparing Canadian debt to American debt or Australian debt? Why? What is the reason behind it? And then I'll take it a step further, Jim. Why are our politicians allowing this conversation to be on the airwaves? Why is the Minister of Finance, the Bank of Canada, the Minister of Housing allowing this conversation even to be on our airwaves without rebuffing it, without explaining it to Canadians how awesome Canada is? There is no other country in the world where a dual income, minimum wage earning couple can raise 2 kids, become millionaires in 30 years, and have their kids own their home and have their kids have a fully paid for post-secondary education. There is no other place in the world where that is possible. And I want to say something to our millennial listeners too, Jim. In 1990, in the 1980s, boomers did not have that opportunity. You could not gain that level of wealth in this country if you began your family life in the 80s and 90s. It was only with the changes to the healthcare system, health insurance programs, income tax systems, and more specifically, the introduction of the TFSA that has allowed you this opportunity. I respect that you see housing prices and you're listening to this false narrative by rating agencies and the IMF and every other person out there who thinks they're a housing expert. The truth of the matter is, minimum wage, dual income, family of 4, millionaires in 30 years, plus owning the home, and your kids get a free post-secondary education. That is an unbelievable life.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HouseStreet.com radio. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at HouseStreet. Questions for the show or our guests can be sent to info@HouseStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.